All right, let's just jump right into this explainer, because we've got a lot of dots to connect today, from what was honestly a truly historic week. We're looking at this incredible moment where peace treaties, central bank shifts, and literally trillion-dollar valuations all just collided in real time. It's a massive web of cause and effect. So today we're going to map out exactly how one single geopolitical shockwave cascaded through every corner of the financial world, ultimately leading to some history-making wealth.
Here's our roadmap for the breakdown. We'll be hitting the US-Iran peace deal, checking in on markets and central banks, looking at crypto's rebound to 66K, diving into Musk's trillion-dollar milestone, and finally, weighing the cost of global fragmentation.
Starting right off with Section 1, the US-Iran peace deal. We have to begin with this monumental shift in the Middle East, which instantly sent shockwaves across global markets.
So, what actually happens when a decades-long conflict just suddenly pauses? Well, this week, we saw that exact scenario unfold when the US and Iran finalized a 14-point draft framework to end hostilities. And a huge absolute game-changer piece of this is the agreement to reopen the Strait of Hormuz. To put that into perspective, reopening this one single waterway instantly eases one of the world's largest bottlenecks for energy. An enormous percentage of the global oil supply squeezes through this specific channel, meaning its status literally dictates global energy security.
And you know, it is incredibly rare to see this level of immediate, unified consensus across such a massive political spectrum. I mean, we've got Donald Trump stating the deal will bring peace and security to the whole region, right alongside UN Secretary General Antonio Guterres calling it a critical step towards the peaceful settlement of the conflict. Plus, you've got European powers like the UK, France, and Germany all signaling a strong readiness to ease sanctions. It's a very rare moment of broad international alignment on a deeply complex issue.
Let's trace the timeline proposed here, because it is moving fast. We're talking an immediate military ceasefire across all fronts, combined right away with the lifting of naval blockades. Then we hit a crucial 30-day window where the Strait of Hormuz officially reopens under Iranian arrangements, which gets that energy flowing freely again. And finally, right at the 60-day mark, formal negotiations on a final, comprehensive settlement are set to begin, covering the big stuff like long-term economic reconstruction.
But here is the absolute kicker: $24 billion. Reports are indicating that this draft agreement includes the immediate release of $24 billion in previously frozen Iranian assets, and half of that massive sum is reportedly made available before those 60-day talks even get underway. That is a sudden, enormous injection of capital that fundamentally alters the immediate economic landscape of the region.
Moving right along to Section 2, markets and central banks. Let's see how traditional finance rapidly absorbed this massive geopolitical earthquake.
What's really fascinating here is the massive split screen we saw across asset classes. With the Strait of Hormuz reopening, global energy supply fears practically vanished overnight. That sent Brent crude oil plunging 4% down to $83 a barrel, and the US dollar hit a 10-day low. But on the flip side, we saw a sudden, massive explosion in risk appetite. Investors were suddenly ready to make much bigger bets, sending equities like the S&P 500, the Nasdaq, and Japan's Nikkei absolutely surging.
And all of this market euphoria is crashing head-on into what analysts are dubbing Super Central Bank Week. We are watching the Bank of Japan potentially hike interest rates to 1%. Now sure, 1% sounds low, but for Japan, that is a 31-year high. It signals a historic end to an era of essentially free money over there. Meanwhile, in the US, new Fed Chair Kevin Warsh is making his highly anticipated debut. Throw in the Bank of England, which is expected to hold steady at 3.75%, and you've got this perfect storm of macro monetary policy and geopolitical relief all hitting at once.
All right, Section 3, crypto rebounds to 66K. Because this thawing of geopolitical tension didn't just impact stocks and oil, it completely blew the doors off digital risk assets.
The sudden surge past 66,000 and actually touching 67,000 for Bitcoin, alongside Ethereum breaking 1,800, caught bearish traders entirely off guard. It triggered a violent short squeeze. Basically, traders betting against the market were forced to buy back in at higher prices to cover their rapid losses. This cascading effect liquidated nearly $588 million, wiping out around 120,000 individual leverage positions in just 24 hours. Just to give you an idea of the sheer scale here, a single forced liquidation on an Ethereum contract on Binance was valued at a jaw-dropping $12 million all by itself.
This totally explains why major institutions are pivoting their tone so fast. Standard Chartered has officially declared the crypto winter over. holding firm on a year-end target of $100,000 for Bitcoin. They're pointing to three macro headwinds that are completely evaporating. First, the huge liquidity drain from the recent SpaceX IPO, that's done, freeing up capital. Second, Middle East geopolitical risks are obviously cooling down. And third, spot ETF net inflows have aggressively returned. Deep-pocketed institutional money is pouring back in, with over $85 million flowing in during a single day.
And we can see this institutional confidence clear as day in the data. Bitmine Immersion Technologies just snapped up another 76,000 Ethereum this past week. They now hold 4.66% of the entire network's global supply. They are rapidly closing in on their massive 5% target. To fund this buying spree, they issued over $270 million in preferred stock. Their chairman actually cited the tokenization of Wall Street assets and the explosive rise of AI systems as the fundamentals driving this aggressive play.
Which brings us to Section 4, Musk's trillion-dollar milestone. Speaking of huge capital flows and visionary bets, let's pivot to the tech sector, where this risk-on environment fueled a truly historic valuation.
Following an absolutely overwhelming IPO where 520 million shares traded on day one, pushing the stock up nearly 20%, SpaceX shares just kept going, jumping another 7% in pre-market. This incredible demand is driven heavily by Starlink's massive competitive moat, plus the virtually limitless potential of space-based AI data centers. It's a combo that pushed the company's total market cap to an astronomical $2.2 trillion. It completely resets how we even think about valuing commercial space exploration.
But what's truly mind-blowing is what this means personally. This immense valuation briefly pushed Elon Musk's personal net worth to $1.2 trillion. Let that sink in for a second. Thanks to his 40-ish% equity in SpaceX, along with his stakes in Tesla, Neuralink, and the rest, he officially became the very first individual trillionaire in human history.
Finally, Section 5, the cost of fragmentation. Because amidst all this market euphoria and record-breaking wealth at the top, we really need to zoom out for a reality check on the broader global economy.
There's definitely a shadow to all this growth. A new report from the World Economic Forum highlights the rapidly escalating threat of geoeconomic fragmentation. Essentially, this is the disruption of global trade and finance through tariffs, investment restrictions, and retaliatory policies, and it comes with a massive, tangible price tag. We're talking an invisible tax on the global economy costing between $213 billion and $307 billion every single year. And surprisingly, this isn't just happening between rivals. Friendly nations are doing this to each other too, which is estimated to bump global inflation by up to 0.3 percentage points.
And the pain here is incredibly disproportionate. While the overall global economy could lose 6.4% of its GDP in a worst-case fragmentation scenario, emerging markets would get hammered with a devastating 10.7% loss. Why such a big gap? Well, emerging economies generally have shallower capital markets. They rely heavily on international capital flows, which leaves them highly exposed to the downsides of a divided global financial system.
So, as we wrap up this explainer, I really want to leave you with this provocative thought. In a world that is currently popping champagne over trillion-dollar tech milestones and breathing huge sighs of relief over sudden peace deals, how resilient is our interconnected financial system against the rising tide of global fragmentation? Like, as capital flows freely to create unprecedented wealth at the very top, how fragile is the fragmented system supporting it all underneath? It's a deeply complex dynamic for sure, and definitely something we all need to keep a close eye on as the dust settles. Thanks so much for joining me to connect these dots today.